After studying this module, you shall be able to learn about the financial intermediary, identify the financial needs of an emerging market, evaluate advantages and disadvantages of financial intermediary, analyze the role of financial intermediaries and various services and instruments being offered by different intermediaries. In the previous module, we have learnt about the financial market system and its two components, that is money market and capital market. We also learnt about how the development of financial market and economic development are interlinked, various instruments of financial markets which are used to channelize the funds. In this module, we will learn about the different types of financial intermediaries, services which they offer, along with their advantages and disadvantages. Along with the basic concept of financial intermediaries, we will also learn about why an emerging market needs financial intermediaries and how these financial intermediaries help an emerging market to efficiently allocate its resources. Financial sector growth is the key driver for economic growth of an economy. Corporate investments, whether direct or institutional, facilitates the firms to raise capital and finance their upcoming as well as ongoing projects. The financial sector includes financial intermediaries, financial markets like stock exchanges, etc. In past few decades, the linkage between economic development and financial sector growth has deepened due to the advancement of technology. Technological advancement and advanced understanding in this sector has acted as a catalyst in the transformation. A number of financial institutions have emerged and flourished during this period. The financial intermediaries offer a wide range of facilities ranging from borrowing at a cheaper rate to secured lending to liquid markets, etc. Financial intermediaries. A financial intermediary is an entity that acts as a middleman between two parties, firms or individuals in a financial transaction. A financial intermediary could be a bank, building society, insurance company, investment bank or pension fund. Along with offering a number of benefits to the average consumer, including safety, liquidity and economies of scale, financial intermediaries also facilitate an individual or a firm to save, lend or borrow money. Financial intermediaries range in terms of size and scale of operation. It ranges from a small insurance brokerage to giant global institutions like JP Morgan Chase, ICICI Bank, etc. that provide a complete range of financial services including commercial banking, investment banking and asset management. Types of financial intermediaries. There are different types of financial intermediaries which are available in an economy. Let us discuss about them in detail. First of them among this category is insurance companies. Many times individuals or firms invest in a project which are risky. By saying risky, we mean actions taken in spite of knowing uncertain outcomes. For example, a paper manufacturing firm continues to produce in spite of the fact that there can be a fire at the factory which will destroy all of his resources and outputs. To insure itself against such kind of risk, it goes to an insurance company that offers it insurance by spreading the risk of default among the pool of other insurance seekers. The insurance companies in turn charge a premium from their clients. The second type is financial advisors. A financial advisor is the one who offers specialist advice on your behalf while choosing a suitable investment for yourself. The specialist advice from the market experts saves you from understanding all the complexities of the financial markets and spending time looking for best suited investment. The financial advisors or portfolio managers prepare an investment policy statement for each of their client, which states the ability as well as the willingness of the investors to bear risk, return objectives, preferences, etc. On the basis of these informations, the financial advisors construct a portfolio for their client which comply with their investment policy statements. The financial advisors usually charge a combination of fixed fees and performance based commission for constructing and managing their clients' portfolios. The third type is credit union. Credit unions are very common in emerging economies where financial market system is not too strong. These are informal types of banks which provide facilities for lending and depositing within a particular community. Fourth type is mutual funds or investment trust. Mutual fund investments are getting very popular these days. Individuals with smaller savings and limited knowledge of financial markets are the ones who are benefited the most. A firm pools small savings of individuals or firms. The pool is then managed by a team of market experts who have an in-depth knowledge of the financial market and its intricacies. The fund manager invests the pool of these small savings into big investment funds which have diversified risk, that is, a portfolio of stocks which have lower correlation between them, have lower risk, and the possibility of loss is diminished. The smaller commission rates available on big purchases and expertise management enables the small investors to benefit from being part of a larger investment trust. The next topic which we are going to do is benefits of financial intermediaries. Following are the benefits of financial intermediaries. First, existence of sound financial intermediary reduces search cost. People don't have to look for right lender or borrower as that function is performed by a specialist. Second, the pool of borrowers spreads the risk of default of the lender. As a financial intermediary forms a pool of savings from depositors and lend these out again to a pool of borrowers. Thus, the risk of default gets diminished. A giant financial intermediary with vast network operates at a lower average total cost and charges lower commission for each transaction, hence enables its customers to enjoy economies of scale. Fourth, without the existence of a financial intermediary, it would be difficult for a borrower or for a lender to find right person to either lend or borrow from and the exact sum of money which is willing to borrow or lend. The next are the potential problems of financial intermediaries. First, a financial intermediary does not guarantee the spread of risk, as there can be the poor management of collected pool and suitable steps may not be taken while scrutinizing the potential borrower. Second, asymmetry of information between customers and financial intermediary may cause moral hazard. A financial intermediary does not always share all the information about the investment with their customers. An investment in high risk bearing corporate or government bonds may result in loss of money. One of the popular example of such situation is Lehman Brothers bankruptcy case. Lehman Brothers, one of the largest financial intermediary in the world, went bankrupt after investing a huge sum of money in mortgage debt bundles. The magnitude of the market capitalization of Lehman Brothers was very large, which result in the default of many other financial intermediaries which were directly or indirectly linked with it. The failure of a chain of financial intermediaries pushed the entire world economy into recession. Third, a financial market runs on the liquidity and the confidence of the people. In some economies, to earn more profit, banks keep only 1% of the total deposits with them and lend out the rest. If there is any failure in the confidence among people towards the banking system, they will rush to the banks and ask for their deposits. If such situation happens, it will collapse the entire financial market of the economy. Emerging markets. A market is said to be emerging if it is progressing towards becoming advanced and developed, measured by some liquidity in local debt and equity markets and a satisfactory level of confidence among citizens towards its financial market system. The existence of strict regulatory body for market exchange deepens the confidence of the citizens and protect their interest. The emerging markets continuously strive to achieve high level of liquidity and confidence in their financial market system. To meet the goal, reforms are executed to gradually increase the market efficiency and strictness in the standards governing financial market transactions and protecting the consumer's interest. In India, SEBI formulates and looks after the stock exchange transactions. Emerging markets also attract foreign investors as they usually offer high rate of return because of the rapid economic development and GDP growth. But this return coexists with high risk of political instability, poor domestic infrastructure, volatility in currency exchange rate and limited equity opportunity. Also, local stock exchanges do not offer the desired liquidity in the market for outside investors. The next is financial needs of an emerging economy. An emerging economy faces a large number of challenges while moving towards advancement. They need to finance their investments in domestic infrastructure, defense, research and development projects, healthcare facilities, education, social security of citizens and many more. Unlike the developed and advanced economies, The emerging economies have shortage of funds to finance their developmental needs. To overcome the situation, a strong financial market system is needed. The role of financial intermediaries then become important for these economies to reach the advanced level. The next topic is role of financial intermediaries in emerging markets. All the financial needs cannot be financed through the means of borrowing and issuing government bonds. The most suitable way to gather funds is through public and private savings. To increase the saving rate, a sound banking system is needed. A sound banking system implies reach to the masses, efficient allocation of resources, desired level of liquidity, better banking facilities, etc. With increased saving rate and growing GDP, an economy is able to raise a substantial sum of money to fund their upcoming and ongoing projects. Also, borrowers enjoy credit at a relatively cheaper rate. The two components of financial markets serve two different financial needs. The money market helps the emerging markets to fund its short-term financial needs such as payment for buying raw material, repairing of an old machinery, payment to creditors, etc. Whereas capital markets help emerging markets to fulfill their long-term needs such as investment in acquiring a new plant, installation of a new machinery, research and development projects, etc. Banking system is the best channel for the government to allocate cash subsidies efficiently. In countries like India, cash subsidies on LPG cylinders are directly transferred into bank accounts of the households. This mechanism not only reduces the cost of transfer but also ensures its allocation. Technical advancement in banking sector like net banking, ATMs, etc. has fastened the velocity of money transfer and hence it has increased the liquidity to some extent. Financial intermediaries help corporate sector to raise funds through the means of IPOs and FPOs. While issuing the IPOs and FPOs, corporate houses need a clearing house to deal with public and collect money. Banks are the most popular financial intermediary to serve this purpose. Stock exchanges ensures liquidity by connecting buyers and sellers of securities in the market. Along with the trade of equity shares, mortgage-based debt bundles, government bonds, corporate bonds, commodities are traded on the stock exchanges. By forming credit unions, small traders and businessmen finance their short-term projects. Credit unions are informal financial bodies which provide instant credit to the seekers. Credit unions in emerging economies have got wide popularity because of its easy terms and efficiency in resource allocation. Apart from hard investments, soft investments also need the existence of financial intermediary. Soft investments means investment in healthcare facilities, skills of the citizens, social security, etc. Healthcare. There are many financial intermediaries which provide life insurance and health insurance facilities. The insurance ensures a part of or all the cost of the consumer's healthcare. Health insurance facility has provided a remarkable contribution to uplift the health standards of emerging economies. Education. There are many students in emerging economies who drop their education because of the shortage of funds. By providing education loans at cheaper rates with easy terms, financial intermediaries play a very crucial role to develop human capital of the economy. Social security. By providing schemes like pension funds, retirement plans, financial intermediaries ensure better standard of living of the citizens in future. One of the most common structure of the plan has a design where an individual saves a part of his income at fixed interval of time, usually a month, till his retirement and receives it, that is the principal amount deposited plus the interest compounded monthly or the fixed interval at which he deposits the money back after his retirement as a pension every month, or the pre-agreed fixed time interval till all his money with compounded interest till date is returned. Summary. Let us now summarize what we have learnt in this module. We have learnt about the financial intermediaries and their linkage with economic development. We have also learned about the different types of financial intermediaries, which include stock exchanges, mutual funds, credit union, banks, insurance companies, etc. Advantages and potential disadvantages of the financial intermediaries have also been covered up in this module. We have learned about the emerging markets, financial needs of an emerging markets, and how the financial intermediaries help these markets to finance their short-term and long-term needs. We have also learned about the soft investments and its use in emerging markets, along with the role of financial intermediaries in uplifting the standard of living in an economy.